Good day. It's my pleasure to welcome you back again to another class. Last time we discussed about the issue of shares. That is a process of allocating or allotment of shares to an individuals or corporate bodies. And uh, shareholder can also be an individual as well as the corporate bodies or business organization. So we also discuss about the classes of shares. Under the classes of shares, we have preference shares, we have ordinary shares, and deferred shares. We all discussed about this in our previous lesson. But today, we want to look at the preparation of the issue of shares. This is the accounting procedures for preparing the issue of shares. So, but before I proceed, I would like to share this lesson objective with you. Lesson objective with you. At the end of the lesson, students should be able to define issue of shares at par, discount, as well as a premium. Discuss the payable by installment and prepare the accounting procedures for issued shares. Let us look at the meaning of issue of shares. Issue of shares for public subscription is one of the ways by which a company can raise capital. So if the company want to raise capital, then they are going to issue shares to the for public to come and subscribe, for public to come and buy the shares from them. And shares can be issued at par, discount, and premium. Let us look at the uh, shares issued at par. This is a situation whereby shares are quoted at the normal price. So the normal price we are talking about, the normal value is equal to the issuing price. Like for instance now, for example, Building Limited issue 200 shares at 2 naira each, at 2 naira per shares. So at 2 naira each, 2 naira each for shares at 200 naira shares. Then at the same time, the shareholder also pay 2 naira. So that is at par, at equal, simply means at par. At 2 naira shares, the shareholders also pay 2 naira, that is at par. So let us look at discount as well. At discount, shares issued at a discount. This is a situation whereby shares are quoted below the normal price. Like Dumes Nigeria Limited issue 400,000 ordinary shares of 1 naira each. So they wanted to issue out these shares at 1 naira, then the shareholder also subscribed it for the rate of 75 kobo. So that means at discount. Discount has been given, discounts of 25 naira has been given to the shareholders because when you subtract 1 naira from 75 kobo, you are still going to have 25 kobo. So discount of 25 kobo has already been given to the shareholders. Then shares can be issued at a discount if one, a resolution is passed at the annual general meeting AGM. If a resolution is passed at AGM, annual general meeting, then they can consider the shareholders by giving them discount. Depend on the amount of discount they want to give to the shareholders. Then second one, the shares to be issued at the discount must be of a class already issued. So the shares have to be that should be part of what they want to issue out to the shareholders already. So then third one, the shares must be issued between 1 month after the date of sanction of court. So after the court might have even tell them to issue it out, then that should be within that month. So if it's within that month, then discount can also be given to them. Then the last one is the resolution must specify maximum rate of discount at which it is to be issued. So they have to decide, and the resolution needs to be passed. So before they can decide on the maximum rate of discount to be given to the shareholders. Then the last one is a issue of shares at a premium. This is a situation whereby shares are quoted above the nominal value. Nominal value. So Building Limited issued maybe nominal value above the nominal value is as shares price is greater than nominal value. If the shares each price is greater than nominal value, that is a share issued at a premium. Then Building Limited issued 200 naira shares at 2 naira each. Then at 2 naira each at 3 naira per share. No, that is a profit of 1 naira there. When you subtract 3 naira from 2 naira, you are going to get 1 naira. So that means at a premium. So at a premium simply means that premium already, the profit of 1 naira is already there. So the premium can be used for the following reasons. One, in writing off preliminary expenses. So after they might have written off the preliminary expenses, then they will now consider that shares need to be used out at the rate at the premium rate. So second one is in writing of written off the expenses of issued shares or debentures such as commission. So maybe as a result of that as well, in providing for a premium on redeemable preference shares, there's some shares that need to call back. So if that shares is still within the jurisdiction of the shareholders, and if the company can be able to call it back from that's redeemable preference shares, if you can be able to call it back from the shareholder, get it back from them, then that is the redeemable preference shares. So we also have the payment payable by installment. Payable by installment. That is, the following stages must be followed when shares are paid by installment. One, invitation to the public through prospectus needs to be considered. Applications are received with money. So there's no any application received without money is not part of the payable by installment. Shares are allotted to successful applications. Then excess application money are refunded. So when they receive more than what they are expecting, then the excess amount of money need to be refunded to the unsuccessful applicant. Then application money must be hedged against money payable on allotment. Then balance of allotment are received. The balance of allotment will be received. First call money will be received. First call money will be received, and second call money will be received on the final call. So that is it. Then we have the question here. Mr. Okete issued out 10,000 ordinary shares at 1 naira each payable as follows. One, 10 kobo on application. Two, 20 kobo on allotment. Three, 40 kobo on first call. Four, 30 kobo on second call. You are required to show the ledger account to record the above transaction. Let us look on how we are going to prepare this account. So one, mind you, the application, the shares we are giving that need to be utilized 10,000 ordinary shares, and for the application we have 10 kobo. How do I arrive at 0.1? 10 kobo, just 10 naira, 10 kobo, you divide it by 100 kobo. 10 kobo divided by 100 kobo, that will give us 0.1. 10 kobo, just divide 10 by 100, you get 0.1. Then that is 0.1, you multiply by 10,000, then you get 1,000 naira. Then for the allotment, allotment is also, we have the shares we are giving is 10,000 at 20 kobo. And that 20 kobo is 20 divided by 100, you get 0.2. So when you multiply 0.2 by 10,000, you get 2,000 naira. First call, 10,000 multiplied by 40 kobo. How do I arrive at 0.4? Just divide 10 kobo divided by 100 kobo. 100 kobo make 1 naira. 100 kobo make 1 naira. So 100 kobo is equal to 1 naira. and before you can get 1 naira, that will be 100 kobo. So 40 kobo divided by 100 kobo, that give us 0.4. So multiply by 10,000, you get 4,000 naira. Second call, 10,000 ordinary share multiplied by 30 kobo. How do you get 30 kobo? That is 30 over 100. 30 over 100 multiplied by 10,000 ordinary share. So when you multiply, you get 3,000 naira. Then using joint application and allotment account. So let us look on how we are going to prepare the journal entries. Journal entries. The first thing, you debit 3,000 naira of bank account and a credit application and allotment account of 3,000 naira. Then you comment, you are going to have the comment there, being money received on application. Then that 3,000 application and allotment, 3,000 will be debited. Then ordinary share capital, 3,000 naira will be credited. Then first call, we got 4,000 naira. By the time we multiply 0.4 by 10,000, we got 4,000 naira. That's first call. First call you credit it. The bank account of that first call you debit it. Then be money received on first call. Then for the you are still going to debit that amount. First call, ordinary share 4,000 naira. Then ordinary share capital 4,000 naira. For the second call is 3,000 naira for second call, and ordinary share capital 3,000 naira will be credited. Then be money received on second call. That is the end of the journal entry. Then we also have ledger entries as well. Under the general entries, we have bank account. The bank account we are giving, mind you that we are giving 10,000 ordinary share. This 10,000 ordinary share we are giving. Let us look on how we are going to get the bank account. Application and allotment of 3,000 naira. Then first call 3,000 naira, and second call, first call is 4,000 naira. Then second call is 3,000 naira. 3,000 plus 4,000, that will give us 7,000. 7,000 plus 3,000, that is 10,000. That's how you are going to get your bank account. You can see the account balance, both sides, both bank account of 10,000 naira and the credit side of 10,000 naira. Then application allotment account, 3,000 naira ordinary share capital, and credit side is 3,000 naira, 3,000 naira at the credit side. Then first call account, we have ordinary share capital 4,000 naira, then bank 4,000 naira. So let us look at the second call. The second call account, we have ordinary share capital 3,000 naira, bank 3,000 naira as well. Then let us look at the ordinary share capital account. Ordinary share capital account, we have application and allotment account 3,000. First call is 4,000. Second call is 3,000 naira. 3,000 plus 4,000, that is 7,000 plus 3,000, that is 10,000 naira. So that one will give us the same balance. You can see 10,000 at credit side as well as 10,000 at the debit side. So let us look at the using separate account for allotment and application. This is the second method. If you don't want to combine allotment account and application account together. So we have bank account, debit side, we have application of 1,000, allotment of 2,000. First call is 4,000, and second call is 3,000. Mind you, let me explain this. Application and allotment, if you want to combine it together, we got 3,000 naira in the first method that we use. Then we've separated them. Application is 1,000, the allotment is 2,000 naira. But this first method we use, we combine the two together. We application and when we got it, we said application and allotment 3,000 naira. So if you want to separate them, you can separate them as well. But when you are separating them, you are using the second method. You are using the second method. That is using separate account for allotment and application account. So that is it. You can see that 1,000 plus 2,000, that is 3,000. 3,000 plus 4,000, that is 7,000. Then 7,000 plus 3,000, that is 10,000 naira. So then you are going to prepare the application account. If it's not a separate account, you can also say that application and allotment account. So this account, I'll be try to separate them. So application ordinary shares is 1,000. Then bank for credit side is 1,000. Allotment account, ordinary shares 2,000. Then bank is also 2,000 naira. So that is the separate account for the application and allotment account. Then first call. Under the first call, we have 4,000 naira. Then the you are also go to get credit the bank account for the first call account. That's 4,000 naira. Then second call, 3,000 for ordinary share. Then for bank, is also we also have 3,000 at the credit side. Then the ordinary share capital application is 1,000. After that, we second method we separate application from my allotment. Allotment is if it's together, application allotment, you write 3,000. That means 1,000 and 2,000 naira. You write them together. So therefore, this account you separate the application 1,000, allotment is also 2,000 naira. First call is 4,000, while the second call is 3,000 naira. You add everything together, you get 10,000 naira. Then for both sides, you have 10,000 naira. Then here's the second illustration, the second example. Building Limited is 200,000 ordinary shares at 1 naira each at 1 naira 20 cover. 1 naira 20. This is the premium account. Premium. You can see premium here, including the premium account. Payable on application 25 cover. Payable on allotment, including premium 40 cover. First call is 35 cover. Second call is 20 cover. Show the ledger account to record the above transaction. Application is 20,000 multiplied by 25 cover. How do we arrive at this? How do we arrive at 50 cover? At 50,000 naira. 50,000 naira. This 200,000 multiply 200,000 by 0.5. How do you get the 0.25? I multiply by 0.25. Then how do you get 0.25? You multiply the divide 25 kobo by 100 kobo. 25 kobo by 100, 25 naira by 25 divided by 100 will give you 0.25. Then multiply 0.25 by 200,000. That will give you 50,000 naira. So allotment premium. For you to get allotment premium, you know that in the question we are giving, they're supposed to issue out at 1 naira. Then it was later issued out at 1 naira 20 kobo. So the premium of 20 kobo, that is the profit. So the 20 kobo. So you are going to subtract 1 naira 20 kobo from 1 naira. That means you are going to get 20 kobo. So multiply that 20 kobo. How do you get 20 kobo? How do you get this 20 kobo? You subtract 1 naira 20 kobo from 1 naira. So that is a 20 kobo, 20 kobo divided by 100 kobo. Simply means 20 divided by 100. 20 divided by 100, that will give you 0.2. 0.2, when you multiply by 200,000, that will give you 40,000 naira. Then allotment is allotment capital. That's 200,000 multiplied by 20 kobo. 20 kobo. How do you get 20 kobo? I will go 20 kobo by you subtract 40 kobo from 20 kobo. That means you multiply 200,000 by 0.2. When you multiply 0.2 by 200,000, that will give you 40,000 naira. Then first call 200,000 multiplied by 0.35. 0.35, that's 35 kobo divided by 100 kobo. 35 divided by 100, that gives 0.35. Then that will give you 200,000 multiplied by 0.35, that will give you 70,000 naira. Then second call, 200,000 naira multiplied by 0.2. 0.2, that is 200 divided by 100 kobo. That will give you 40,000 naira. So then we also have we are going to prepare the normal accounting account, the normal ordinary share account. There we have application 50,000 naira, allotment 80,000 naira. You are going to get this from the working we have shown you the other time. First call 70,000 naira. Second call 40,000 naira. When you add all this together, we do 240,000 naira. Then we go to the application and allotment account. That is a combination of the account. We have ordinary share capital, ordinary capital 90,000, premiums 40,000. So when you add them together, that will give you, then the bank account is 50,000. They are going to be 50,000. The bank account for the second one is 80,000 naira. So 50,000 and 80,000, that will give 130,000 naira. Then add 90,000 and 40,000, it's still 130,000. You can see that both sides of the account are equal. 130,000 for debit side and 130,000 naira for the credit side of application and allotment account. Then share capital account, application and allotment account 40,000 naira. Then let us look at the first call, second call, and ordinary share capital. First call, second call, and ordinary share capital. First call, ordinary share capital is 70,000 naira for debit side. Then for credit side, bank is also 70,000 naira. Then second call account, ordinary share capital is 40,000. Then for the credit side of second call account, we have 40,000 naira. Ordinary share capital account, we provide both debit side and credit side. Application and allotment account 90,000. First call 70,000. Then second call is 40,000 naira. You add all these two together, we are going to arrive at 200,000 naira, 200,000 naira for both sides of ordinary share capital. Then let us look at the other side of the account. We have payable instrument A Limited, having previously issued 70,000 ordinary shares of 1 naira each. Take the necessary steps and is empowered to issue 40,000 shares at a discount of 5 kobo, payable as follows: 20 kobo on application, then 20 kobo on allotment. That is a discount. That discount has been given to the shareholders. Then we have 60 kobo on first and final call. Then we are going to prepare the show the journal entries. So let us look at the journal. Before we look at the journal entries, we are going to prepare look at the working aspect of it. Then under the working aspect of it, we have applications. Mind you that 40,000 naira ordinary share was given. That was ordinary shares 40,000. Then on application we have 20 kobo. 20 kobo. That 20 kobo is 0.2. How do you get 0.2? Just I've told you the other time that 100 kobo make 1 naira. So divide 20 kobo by 100 kobo. That will give you 0.2. So multiply 0.2 kobo by multiplied by 40 kobo. That will give you 8,000 naira. Then for under the allotment, that is allotment, that is discount. 5 kobo, multiply 5 kobo by 40,000 naira. That will be 0.05. That is 5 kobo. Just divide 5 kobo by 100 kobo. That means simply divide 5 divided by 100. That will give you 0.05. So when you multiply by 40,000 naira, 40,000 ordinary share, that will give you 2,000 naira. Then for the ordinary share capital, how do we get our ordinary share capital? 20 kobo minus 5 kobo. That will be when you subtract 20 kobo from 5 kobo, that will give you 50 kobo. Then that 15 kobo divided by 100 kobo, that will give you 0 naira 15 kobo, 0.15. Multiply 0.15 by 40,000 ordinary share, that will give you 6,000 naira. So you can do that by you can press your calculator, then you get it. The first and final call. First and final call is 60 kobo. How do you get 60 kobo? 60 kobo is divided by 100 kobo. So 100 kobo make 1 naira. That will give you 0.6. Multiply 0.6 by 40,000 ordinary share. That will give you 24,000 naira. So let us look at the journal entry, the journal entries as well. So this is the journal entries. Application and allotment account, you credit 8,000 naira, bank you debit. Then your comment will be cash received on application. The application and allotment account 8,000 naira, ordinary share capital You can see that in the previous working I showed you the other time. That's 8,000 naira. That means being allotment of shares, application and allotment account 6,000 naira, back account 6,000 naira, application and allotment account again 6,000 naira. Then discount is 8,000 naira. Then ordinary share capital, when you add 6,000 and 8,000, 6,000 and 6,000 and 2,000 naira, 6,000 and 2,000, that will give us 8,000 naira. The ordinary share capital 24,000 naira. Then back account 25,000 naira. First call is 24,000, and the ordinary share capital of that first call is 24,000 naira. Then we also have there are some ledgers that I want to look at. Back account, we have under the application, that's 8,000 naira. Allotment is 6,000 naira. First call and final call, 24,000 naira. So when you add everything together, that will give us 13,000 naira. That's for the back account. Application and allotment account, share capital, 16,000 naira. Then you credit back account 8,000 naira for application. Then back account for the allotment account 6,000 naira. Mind you, under our working the other time, we got 2,000 naira for the discount, 2,000 naira. So let us add everything together. That will give us 16,000 naira. Then share discount account, 2,000 naira, application and allotment account. So then final and first and final call account, ordinary share capital 34,000 naira. Then back account is 24,000 naira. Then let us look at the final, first and final account. Application and allotment account 60,000. First and final call account 24,000 naira. When you add 60,000 naira and 24,000 naira together, that will give us 40,000 naira. So, my student, this is the end of the preparation of or accounting procedure for preparing the issue of shares account. So this is how you are going to prepare the account. I wish you the best of luck. So I wish you the best of luck. The best thing for you to know this account is by having your this textbook, principle of bookkeeping and accounting by Femi Longe. Principle of book account by Femi Longe. I wish you the best of luck.